Welcome back to the deep dive. We're here to sift through those dense financial reports, find the real insights.
Through the noise.
Exactly. Today, we're tackling Patanjali Foods Limited, or PFL. We've got their Q2 and H1 FY26 results and the management commentary.
Right.
And the big headline here, record numbers, highest ever quarterly and half-yearly performance. Revenue, profit, the works.
Yeah, it was pretty impressive.
So our mission is to figure out how, what drove this, and what are these aggressive growth strategies they keep talking about, especially this push for a 50-50 split between edible oils and FMCG in, 4 years?
Yeah, that's the big goal. And it's fascinating because this all happened during a really turbulent time for the whole FMCG sector.
Turbulent how?
Well, you had major structural changes like this GST 2.0 rate rationalization plus ongoing commodity volatility.
Huge headwinds.
So PFL showing this kind of resilience, hitting record highs while also restructuring, it says a lot.
All right, let's dig into those record numbers first. Just how big was Q2 FY26?
Well, standalone revenue from operations hit 9,798.84 crores.
Almost 9,800 crores.
Yeah, which is a year-on-year growth of nearly 21%.
21%, that's substantial. And profitability?
Kept pace. Total EBITDA was just over 603 crores. That's up 22% year-on-year.
And healthy margins, too.
PBT margin was 5.13%. And for the first half, H1, revenue crossed 18,500 crores, with EBITDA around 937 crores. Solid performance.
No, there was a little asterisk on the Q2 profit, right? Something about a tax refund.
That's right. The profit after tax, the PAT, got a one-off boost. A tax refund from previous years, about 141 crores. So good to keep that in mind.
Got it. But beyond the numbers, you mentioned restructuring. What was the big strategic shift?
They've fundamentally repositioned the company. Officially, it's now an integrated FMCG enterprise.
Meaning?
They simplify their reporting segments. Remember, before they had food, other FMCG, and HPC.
Yeah, home and personal care.
Right. Now that's all rolled into one big FMCG segment.
Ah, okay.
So the main segments you see now are edible oils, this unified FMCG, and then the much smaller wind turbine power generation business.
So this signals a real focus shift, right? We're not separate silos anymore. We're one big consumer goods company, and FMCG is the target growth area.
Precisely. It lines up perfectly with that 50-50 revenue ambition.
Okay, that structure change makes sense. Now let's talk about that turbulence you mentioned, the GST game changer. Q2 was tough for the sector because of GST 2.0. What was the pain point?
Yeah, it was a transitional headache. Basically, GST rates were reduced on a lot of finished goods.
Which sounds good.
Long-term, yes. Short-term, no. Because wholesalers and retailers were sitting on piles of inventory they'd bought and paid tax on at the old higher rates, maybe 18%.
Okay.
Suddenly, new stock is coming in taxed at 12% or even 5%. They couldn't sell their old expensive stock without taking a big hit compared to the fresh stuff.
Ah, so they slammed the brakes on ordering new inventory from companies like PFL?
Exactly. They focused entirely on clearing out that pre-GST stock first. And consumers kind of held back too, waiting for prices to drop.
So how did PFL handle that sudden slowdown?
They pushed hard on trade promotions and incentive schemes, basically helping their distribution partners move the old stock and make room for the new.
But wouldn't those promotions hurt their own margins in Q2? Is there a risk that bites them in Q3?
It's a calculated risk, a short-term trade-off. You sacrifice a bit of margin now to keep your products on the shelf and maintain momentum.
Okay.
But the crucial part is the long-term structural win PFL got from this whole GST shuffle.
Right, because their portfolio mix ended up benefiting hugely.
Massively. For their big edible oil segment, the rate didn't change, stayed at 5%.
Yeah.
But for that newly combined FMCG portfolio, almost 55% of those products saw a rate reduction.
Wow.
So if you zoom out and look at PFL's entire business edible oils plus FMCG, roughly 85% of their total portfolio now sits in that low 5% GST bracket.
85%. That's a huge structural advantage compared to competitors with more stuff in higher tax slabs.
Exactly. It's a permanent cost advantage in a very price-sensitive market.
What does management expect this to translate into, actual volume growth?
They're pretty bullish. They anticipate a significant volume lift, maybe 300 to 400 basis points in the coming months.
3 to 4% extra volume just from the GS2 change.
Yeah, either through direct price cuts they can offer or by increasing the amount of product in the pack grammage increases. Better value drives volume, especially in mass markets.
Okay, so GS2 is short-term pain, but looks like definite long-term gain for PFL. Let's shift gears, though. FMCG margins look great, but you said edible oils are still what, 70% of the revenue?
Yeah, roughly two-thirds, maybe a bit more, around 70%. It's still the core revenue driver for now.
So how's that massive segment doing, especially with all the global commodity chaos?
It's holding up. Q2 revenue for edible oils was nearly 7,000 crores, 6,971 crores technically. Still grew over 17% year on year.
Impressive.
And the key here is the branded part. Branded edible oil makes up about 76% of their total oil sales.
Brands like Ruchi Gold.
Ruchi Gold, Mahakash, Sunrich, those flagships delivered really strong double-digit growth in value terms. Brand loyalty matters there.
But the input costs, oils or commodities, weren't prices going crazy?
Oh, absolutely. Palm oil, which is a huge cost for them, surged. It was up 35% year on year and even 20% just compared to the previous quarter.
35%? How did the market react?
It caused distortions. People started switching. Palm oil imports actually fell to their lowest level in years, while soybean oil imports hit a high because the price difference got so wide.
And how did that hit PFL's volumes, even with strong brands?
It did have an impact. Their overall edible oil volume saw a 7% dip year on year, but interestingly, it did recover a bit within the quarter, up 5% compared to Q1.
So some resilience there.
Yeah, and you have to factor in seasonality.
Yeah.
For edible oils, the bulk of the business, like 65–67%, usually happens in the second half of the financial year, H2.
Ah, the festive season, winter demand.
Exactly. So they're expecting a natural pickup in the coming quarters.
Okay, that makes sense. But they also have this long-term play to smooth out that volatility, right? The oil palm plantations.
Yes, that's their strategic hedge, their own internal supply chain.
How's it going?
They hit a major milestone. As of September 2025, they crossed 100,000 hectares of land under oil palm cultivation.
Wow, 1 lakh hectares.
Yeah, and this backward integration really pays off. Look at the profitability of that segment. The segmental EBITDA margin was a huge 24.16% in Q2.
24% margin on growing their own input. That's fantastic.
It really cushions them against the wild swings in global commodity prices. It's a smart long-term move.
Okay, let's pivot back to the future growth engine then, FMCG. That 50-50 revenue split target in 4 years. Current share is just under 30%. That still feels like a massive leap.
It is monumental. Think about the growth rate FMCG needs to achieve.
Yeah.
It has to grow significantly faster than the already large oil division just to catch up, let alone hit parity. It's a huge operational challenge.
So why should we believe it's possible?
Because of the profitability. Here's the kicker. Today, even though FMCG is only about 30% of the revenue, it's already generating nearly 60% of PFL's total EBITDA.
Wait, hang on. 30% of sales drives 60% of the profit.
Exactly. That's where the high-quality, predictable margin is coming from. It's the profit powerhouse.
Okay, that changes the perspective. What were the FMCG numbers in Q2?
Revenue hit almost 3,000 crores, 2,914 crores. That was up a massive 34.3% just from the previous quarter.
Huge sequential growth.
Yeah, and they maintained a strong EBITDA margin too, 12.28%.
So which specific categories are firing on all cylinders? Any standouts?
Definitely. Biscuits had their best quarter ever, almost 500 crores in revenue.
500 crores from biscuits alone.
Yeah, and their main brand there, Dude Biscuit, pulled in over 360 crores just in Q2. That brand alone is now over 1,000 crores annually.
Incredible. What else?
Ghee had a phenomenal quarter, strongest ever performance. Sales hit 447 crores.
Whoa, let me check the notes. A 74% jump compared to Q1, sequentially.
74% quarter-on-quarter growth. Yeah.
That's not just seasonal. That sounds like aggressive market share gain or distribution wins.
It suggests a really strong focus, successful expansion. Even honey crossed the 100 crore mark in the quarter.
Okay.
And they're pushing into new areas too, like nutraceuticals. Launched a new product for renal health care.
So with all this aggressive expansion, what's PFL's unique selling proposition, their edge against the big global players?
Management really hammers home two things. Leveraging the Swadeshi, the Made in India platform,
Right.
and coupling that with a deep focus on natural, healthy, organic, Ayurveda, wellness, that whole ethos.
So it's a values-based positioning as much as a product one.
Pretty much. And it seems to resonate. It allows them to set these aggressive growth targets, like 8–10% for food overall, and even 15% for home and personal care.
Maintaining those growth rates and margins while juggling commodity swings, that requires serious efficiency behind the scenes. What are they doing on cost management and tech?
They're definitely focused on it. They use hedging strategies for raw materials, of course. Inventory management is key.
Sure.
But the big push is in technology. They're implementing the latest SAP H&S system across the board.
Okay, modernizing the back office.
And critically, they have execution plans rolling out now for using AI and machine learning.
AI. How are they using AI? Predicting biscuit demand before Diwali.
Huh, maybe someday. Right now, it sounds more focused on operational efficiency, managing inventory movement and build-up much more precisely.
So like optimizing logistics, knowing where to send oil before a festival to cut transport costs and avoid tying up cash.
Exactly. Precision logistics, reducing working capital needs, making the whole supply chain smarter and faster.
Makes sense. Any other efficiency moves?
Yeah, they're also leaning into sustainability, which doubles as cost-cutting. Using renewable energy, particularly wind power, they mentioned it covers about 22% of their own energy needs now.
Okay. And investments in the supply chain itself.
They got a big certification authorized economic operator, AEO Tier 2. That's a stamp of approval for supply chain security, helps smooth out logistics.
Good for imports, exports too, I imagine.
Definitely. And looking ahead, they've signed a major MOU with the Ministry of Food Processing Industries.
What's that about?
A commitment to invest 1,000 crores across 6 states, building more capacity, basically. Expected to create over 7,000 jobs. It's all about scaling up to support that 50-50 ambition.
1,000 crores, that's serious investment in future capacity. We should also quickly touch on the balance sheet. Saw a note about increased debt.
Yeah, both gross debt and cash went up significantly. But the commentary clarified it wasn't for like a big acquisition. It was mainly due to withdrawing some working capital limits and taking on new credit facilities from banks, likely to fund that growth and inventory.
Okay, so managing the cash flow for expansion. Got it. All right, let's try to wrap this up. Quick recap. PFL hits record numbers. Key drivers seem to be, 1, that internal reorganization really focusing on FMCG. 2, catching a major structural tailwind from the GST changes, making most of their products cheaper.
Yeah, that 85% in the 5% bracket is huge.
And 3, strategic investments paying off both in operational efficiency with tech like AI and in specific high-margin FMCG categories like ghee and biscuits that are just exploding.
That sums it up pretty well. But the core story, the thing for you, the listener, to really watch going forward is that balancing act.
Balancing act.
Yeah, executing this 50-50 strategy. They're effectively running two different beasts. You've got the massive high-volume edible oil business, still 70% of revenue,
Yeah.
but it's super sensitive to commodity prices.
Right, the volatile revenue engine.
And then you've got the high-growth, high-margin FMCG segment, already 60% of the profit, which needs huge investment funded, in large part by those oil profits.
Ah, okay. One funds the other's growth.
Exactly. So the provocative thought is this. Given that aggressive 4-year timeline to get FMCG to 50% of revenue, what kind of external shock could throw a wrench in the works, or maybe even speed it up?
Like what?
Think about it. What if global palm oil prices stayed really low for a long time, hurting the profitability of the oil segment that's funding everything? Or what if a competitor launches a major counterattack in biscuits or ghee, slowing down that FMCG growth? Or maybe a demand shift?
Interesting. So the risk is that the funding engine slows down before the growth engine is big enough.
Or that the growth engine hits unexpected roadblocks? So keep a close eye on that revenue mix quarter by quarter. That's the real scorecard for whether this ambitious strategy is on track.
A great point to end on. Lots to track there. Thanks for joining us for this deep dive into PFL.
My pleasure.
We'll see you next time.